Hey guys, welcome back to the channel. In today's video, we're going to be talking about the jobs report that was released last week and the impact that it's going to have on the stock market. Before we get into the video, go ahead and subscribe to the channel, guys. Turn on notifications, stay up to date on all of our financial news. Let's go ahead and get into it. So as of last week, the jobs report came out. We added 263,000 jobs in September, meaning that the unemployment rate fell to 3.5% from 3.7% in August. Sounds great, right? Having people working is a good thing. Not if you're the Federal Reserve, and that is where the jobs report kind of comes in. According to the data from the Bureau of Labor and Statistics, the sign of the labor market is still strong is bad news for the investment side. Now, why is that possible? The reason is higher inflation, guys. As we see inflation continue to rise, it gives financial hardship. So people that are actually working, it is more expensive to get products and services. And for the Federal Reserve, trying to curb the aggressive rising of interest rates to try to fight inflation. Inflation is about I believe it was 8.1%, which means historically, guys, the cost of doing goods is very expensive. We've seen mortgage rates impacted. We've seen loans impacted. Credit card rates have went up. The cost of living itself for an individual has went up dramatically, which again, having more people working is counterproductive because having more people working, of course, gives them the opportunity to increase demand because they have money to purchase additional goods and services. Now, why overall is this important? When interest rates rise, guys, we see asset trading, stocks, bonds, cryptocurrencies, commodities, all of those are negatively impacted by the job performance. So again, the Fed tries to kind of manage a 6% unemployment rate. Right now at 3.5%, we were almost half of the people that they want to not have jobs, which again, thinking big picture from an individual standpoint, they want about 2.5% of people to quit, leave their jobs, get fired, staff reduction, giving them or essentially taking away the ability to buy goods and services, which of course will drive inflation down. Big picture, again, I don't think it makes sense that we want people not working, we want people not contributing to the economy to go ahead and fight and adjust inflation as we're continuing to really battle this. So good point out was the S&P 500 finished with a lower day on day 6 and 7 after the job data came out. Now, why is this super important? Overall, guys, the job growth is slowing. Employers are adding fewer jobs than they had in the previous month, even though unemployment was a little bit changed. For investors, guys, the trend is saying that the Federal Reserve is going to raise interest rates. Now, first time off, it was a 0.75 that people were thinking. Now it seems like in the near term that it might be up to a full percent, guys, that we could see an impact of an increase in rates, which could drive mortgage rates to 6.5%, 7%, possibly even 8%, much higher depending on where you live. So if you're looking to buy anything, that means it is going to be more expensive to get auto loans, to get products and services, things of that nature. The Fed is very focused on inflation. And essentially for the Federal Reserve, guys, they will do everything to fight the inflation. If it means the stock market falls, it is what it is. Looking at jobs or looking at people that are gainfully employed will be collateral damage. They are going to fight inflation, bar none, exactly what it is going to. Not only that, as when the cost of doing business actually increases, it makes it a lot more expensive for companies to operate. In turn, if you've looked again at the marketplace, the job marketplace, companies have been laying off hundreds of thousands of people to not only offset the rising inflation that we're seeing, the cost of doing business, but also to balance the books. So one of the biggest, most expensive things that we do have within society today is the individual worker. That is why there is such a strong push to automation, because you don't have to pay for the individual worker. They don't have call-ins, they don't have sick days, they don't have benefits. They are cutting the cost essentially with building and developing new technology to allow essentially the workers to be replaced with technology, or having one worker that can cover more and more jobs. So guys, I hope it just kind of gives a little bit of light on why the jobs report is bad news for investors, guys. This means, again, looking at the picture, looking at the larger picture, that the Feds are going to continue to increase rates. They're anticipating currently a 0.75 in October, which we are in right now, 0.5% they're looking at November, and then possibly 0.25% with February of 2023. Now, with that being said, again, it could be higher depending on where the jobs report, depending on where inflation is actually starting to either peak or inflation is starting to come down in the months going forward. If it stays relatively high, we could see a much higher rate increase overall from that. And as a result, for investors, guys, this is going to be bad news. We've seen the market drop dramatically, kind of been a roller coaster ride with what is coming out, and inflation numbers will continue to come out, and we'll have to see where the jobs report comes out for October in the next couple weeks, guys. October is already, a week in, almost 2 weeks in. The economy is trying to find some footing, but it seems like things of this nature are just setting it back by leaps and bounds. So guys, that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.